Hey, not sure if you heard, but the federal government got together this week and trying to figure out what they're going to do about this inflation thing. And they decided, well, in order to stay above inflation, we've got to raise the interest rates, right? They think that's what's going to make a difference, make a big impact in inflation. So they decided that they're going to go ahead and raise our rates about 0.25%. And we're already feeling it across the board. But, there's about 6 more times that they're figuring on getting together in 2022 and actually planning on raising the rates. They think they're estimating right now probably 0.25 point for each time that they raise the rates. So they're going to incrementally increase over the 2022 year. And so what does that mean for you? Well, let's take a look at a couple slides real quick, and let me give you, put it into perspective for you. So here we've got over 200 years of interest rates, right? As you can see, interest rates they go up and down. They got their peaks and the valleys, and we bottomed out back in 1945 during World War II, right? The government debt skyrocketed, and interest rates had to drop aggressively in order to help people, and so that's what they did, right? So that was historically that was the lowest point on record, but then look what happened from there. It gradually went up, and then in who remembers the 1980s, right? 1981 is when we peaked out at 15.8%. And I know there were some areas that actually went up as high as 18%. And I think even in Canada, they approached over 20%. But it was a tough time in the 80s. But there was no real big market meltdown or market crash in the housing market. The housing market kind of stayed flat. And I bought my first house in the 1980s, in 1985, and paid about 11.5% interest on an adjustable rate mortgage. So the world doesn't end. Everything doesn't have to crash just because things are a little bit out of whack, right? So let's take a little closer look at the last 30 years or so. All right, so this is a closer up look at the interest rates in more current times. Going from the 80s. And if you look at the vertical lines are all recessions that we've faced in these past recent years. And as you can see, interest rates, they're steadily going down, right? A lot of peaks and valleys along the way, but we bottomed out in 2021. We've never been that low with interest rates ever before. And now we're starting to climb back up. We're destined to go up, right? Because we've been so low for so long. I mean, how much lower can we go? I used to say, well, you may as well get a mortgage. Instead of buying this home for cash, go get a mortgage, put that cash to work, because you're going to earn more money with that cash invested, and the government's giving away free money for your mortgage. So what does that mean for your purchasing power now that interest rates are going up, right? It used to be, well, interest rates are steadily going down, right? We weren't sure where they would go, but they were going down. So it was like, hey, if you wanted to wait, no big deal, because if interest rates go up, prices go up, interest rates go down, well, it balances out. But right now we've got interest rates are heading up. We've got prices are heading up. So what does that mean for you, the buyer that is trying to buy their next home, right? Whether you're upsizing or downsizing. Well, let's take a look at this chart right here. It's really interesting to see the difference between a 3% mortgage versus a 5% mortgage. And this is the average price point, right? $360,000 to $440,000. So that same, if you were to buy a $440,000 home last year and get a 3% mortgage, your mortgage payment, your principal and interest payment only, would be $1,855 a month. Now, today, you're looking at about 4.25% if you were to get that same $440,000 house, which would actually be more than that today. But that same home for $440,000 would cost you $2,164. Now, a year from now, or maybe even less than a year, if we're at 5%, that same $440,000 mortgage is going to cost you $2,365. You're talking over $500 difference between what you could have done and what you might do. That's $500. That's more than a car payment. That's more than I pay on my car payment and what most people pay. So you got to look at it, put it into perspective. And one of the things too is that once you lock in at whatever low rate you can get, you're locked in for 30 years. Or if you get a 15-year, you're going to be doing even better, but you're locked in, right? If you're renting now and you're looking to buy, your rent's going up every year. You have absolutely no control over that. But with a mortgage like this, you have some control, right? Your principal and interest is going to stay the same. The only thing that'll fluctuate is your insurance and your property taxes. So it might go up a little bit, but it's minimal at best. But it's your home, and whether if you're looking to make a move, obviously you really don't need to be or don't want to be in whatever situation you're in. Either you're renting and you want to buy a home, or you're in a home that you need to either downsize or upsize, right? And so it's always better to do it now as opposed to later. So let's look at the cost of waiting, right? If you bought a house and a house that would have cost $350,000 in 2021, could have got an interest rate of 2.86%, which would have given you a principal and interest payment of $1,449. That same house in 2022 would cost you $371,945, and you'd be paying an interest rate of about 4.25%, making your monthly payment $1,830. All right, that's almost $400 above and beyond what it would have cost you if you had made the move when you first thought about it, but were hesitant because it's like, oh, the market, oh, I'm fearful of the bubble, the market's going to crash. Well, I'm going to have another video here real soon about why the market's not going to crash and all the support that kind of shows what happened last time and why things are in place right now that's not going to let it happen unless somebody comes up with some weird thing that just makes things just go awry. But I really doubt that's going to happen. So let's take a look at home prices, right? Because what's really important to understand is that a home is a long-term investment. So the home prices in the United States, if you would have bought a home in back in the 1990s for $90,000, that home would be worth almost $360,000 today. So you got to take that into consideration. Now that home went up, and peaked out in like 2006, 2007, and then it dropped, right? The value dropped. The value dropped on paper, and the only time you got hurt was, well, if you bought at that top and then you needed to sell for one reason or another. Well, it's pretty hard to buy up here and sell here and not lose money. It's going to happen. It happens to the best of us sometimes. But if you buy a home and your intention is to stay in it for over, for the next 10 years, you're going to be in really good shape and pretty, because look at what happens over the long haul. And let's look at, this is the state of Florida, right? This is property values going all the way back pre-1980, right? And going through all the recessions, riding through the different recessions. Again, the recessions are shown in the vertical gray bars. Okay. And we had a pretty good, recession back in the 2008, 2009 timeframe. And they didn't want to put things into place back in 2008. There was a lot of suggestions on how to keep people in the homes in 2008, 2009. And the thing was the banks just wanted to keep taking the properties back, right? They'd rather take the foreclosure rather than work with the homeowner and get them do some sort of fix to help them stay in their home. Things are a lot different right now. People do not want to go back through the same thing that they went through then. So as you can see, values are they keep going up. Yes, we've had a very steep incline for the last several years. And at some point that's going to level off. But I anticipate that the higher interest rates are going to help flatten out our market, right? Not make it crash, but just flatten it out, because the demand is going to be there and it's going to continue to be there for quite some time. So let's take let's talk for a minute about why you should understand the mortgage interest rates, right? How are they affected? What affects mortgage interest rates? Because there's a lot of different variables, because again, I mentioned that, they were advertising up until just this week, they were advertising, oh, get your mortgage for 3.7%. That's what we're advertising, right? The reality is I didn't know anybody that was getting anything less than 4.1 to 4.5%. Why is that? Well, there's a lot of variables that go into it. Number one, economy. The economy does determine where interest rates are at, and it's both nationally and globally, right? It has a huge impact on where interest rates are at. But you also have the bond market prices, right? So bonds actually inversely affect mortgage rates. So if bonds are going up, interest rates are dropping. And if bonds are dropping, interest rates are going up. And so we have a little bit of that going on right now. The third one is inflation. Inflation has a direct impact and correlation to our interest rates because, well, we have people behind the scenes saying, well, we have inflation, so let's raise the rates, right? May not make a whole lot of sense to us, but when inflation is in place, they tend to try to raise the interest rates to kind of slow things down and hope that that's going to help offset it. My personal opinion is I don't think that it works, but hey, that's what the government says, so let's go with it, right? Personal credit scores. This is a huge impact, right? No matter how good rates are, the only way you're going to qualify for the absolute best rate is if you have the absolute best credit score and credit history. So it's really important that you do keep up with that. You watch your credit scores, Credit Karma and those types of things. Those are okay to follow. Make sure that, nobody stole your identity and you're keeping up with things. But it's not the most accurate credit score, and your FICO score is what they go by. And so you want to be able to, get your FICO score and watch that and be able to keep an eye on your credit. But look, you need to be up there, right? It used to be that 680 was an excellent score. Now it's like you got to be at 740 to have an excellent rating. So, but at the same point, you just want to make sure you're watching your credit score and you're not doing things that are influential in having that score drop for any reason. And we're going to talk about that too in another video where, things to do and not to do when you're applying for a mortgage and buying a home and how it's going to affect you. So another thing that affects interest rates is your down payment. How much are you putting down? And, look, a lot of people, they want to get into home, but they don't have a lot of cash to spend or liquid cash that they can use. Now you can tap into your 401k or your SEP IRA, and you got to talk to an accountant about that and see, what kind of a retirement account that you have and how you can use that money towards buying a home. But a lot of people don't have a lot of cash liquid for a down payment, right? So you've got to have enough, and there's different mortgage opportunities for you based on your qualifications, and you can go FHA, you can go conventional, there's VA, there's USDA. So there's different routes that you can go that require different amounts of down payment, and of course your rate is going to fluctuate based on how much you put down. Look, if you can put down at least 20% of your purchase, that's going to help qualify you for the absolute best rate. So you always want to remember that, right? The location of the home. I talked about it earlier. It could be a factor of what state you're in, could be the county you're in, the city you're in, how competitive the mortgage companies are in the particular area that you're at. So your loan amount. There's definitely, the amount that you're borrowing is going to impact the interest rate as well, especially if you get up there and the dollar value is different based on different areas. But once you get up there to a jumbo rate and you're trying to qualify for a jumbo rate mortgage, that's when rates are, you're borrowing more than what the cap is on a conventional. And I'm not going to mention the dollar figure here because it does change and it is different in different areas. But once you get into jumbo, there's usually a little bit more upcharge on the interest rate to qualify for that mortgage. Your loan term, the duration of your loan will definitely make an impact. Look, traditionally, we all go for 30-year mortgages, right? But if you can do a 15-year mortgage, you got to get a much better interest rate. You're going to pay off your house much quicker. You're going to build your equity much quicker, and you're going to spend a whole lot less money in interest over the life of the loan. So if you're looking at buying a home, always look at that 15-year option and see if you can swing that payment versus the 30-year payment, because that's how you're going to build your wealth a lot faster. And finally, the interest rate types. It's like the interest rate type is going to vary based on, are you getting FHA, are you getting USDA, are you getting conventional, all these different loan options are going to make an impact on the interest rate that you're gonna qualify for. So look, that's my take on interest rates. I hope that this has been helpful in understanding why it's really important to make a purchase. You're better off making the purchase now because prices can continue to go up. The demand is continuing to rise. People are coming in to Florida from all these other states where they have the money to be able to come in and buy the properties. The cost of the homes going up has no impact on them whatsoever because it's still cheaper from where they're coming from. And the cost of goods, the builders are still, having serious problems on keeping up with the demand and having their supplies come in. So the cost for builders keep going up. And as long as that keeps going up, resales are going to keep going up. So you're always better off get in sooner rather than later. Plan on it being a longer investment for a good 10 years or more. You'll be absolutely safe. Real estate is the safest long-term investment overall. There's no other better. So look, if you're ready to go, give us a call. We'll help get you set up. We can get you set up with a good lender. If you need to talk to somebody, they'll set you up on a good plan. Maybe if you're not quite ready yet, but you're thinking 6 months down the road, well, let's talk to a lender anyway. Let's get a plan in place so that you're ready to go when that time is right. And we can keep watching the market for what you want, what you need, and we'll get you into the home of your dreams. So, hey, I'm Paul Fidinich with the VIP Home Team. Give me a call, 407-744-1681 anytime. We're happy to help. Have a good one.